Okay, and we're live for this short session on what constitutes the invalidation of your trade idea, right? One of the questions I was asked was, if I want to place my damage control trigger at a level or zone where I would consider the trade to be invalidated, how do I go about doing that? Yeah. Again, the ideal way to set your damage control trigger for the most part is going to be a combination of things, right? The trade idea invalidation, structure that breaks, right? A sentiment shifts, your drawdown thresholds, right? It's going to be a combination of everything. You're going to be putting all these pieces of the puzzle together to determine your trade plan, right? And your trade plan is going to have those levels at which you want to scale in at. And then at the end, it's going to have a damage control trigger, depending on all those factors, right? How much are you willing to scale in? How much drawdown are you willing to have? And how much are you willing to give to price action before admitting, that the trade idea is off and that you need to either switch gears into a different bias or immediately start doing damage control, okay? The question that was brought up to me yesterday was more about the, how soon or how fast can I actually hedge, right? So if I place my damage control trigger based on the trade idea no longer being valid, right, because I want to immediately switch bias and hedge, how can I kind of marry those two concepts together? Okay. So let's see. We are going to look at examples randomly. Yeah. So we're going to look at EuroCAD. And we're going to do the H4, I think, for these examples, just to show you what I mean. So this is all going to be just practical looks, yeah? And during the practical looks, we're going to probably talk a little bit about the reasoning behind it, but I think it's going to be pretty obvious to everybody. Okay, so as an example, let's say that you're short here, yeah? EuroCAD on the 4-hour. And price, forget this, moves higher, right? Throughout the trade, and you're scaling in. Again, these levels are random, okay? I'm not selecting them based on anything. I'm just doing random lines here. They don't mean anything, right? In a trade like this, right, where you're scaling in based on a level that you like, a resistance level that you like, right? The marker here that is determining your type of trade is a resistance marker that indicates a mean reversion trade, where price has extended away from the mean or the averages far enough into a key turning point structure-wise where you feel comfortable that price should get a reaction, right? And where you feel the probability of a switch or a turn is higher. This is called a mean reversion trade, right? You're not going with the trend because you're shorting against a pop, right? And you're not range trading because you're not doing longs and shorts. And this is short, this is rangy, right? But you're not range trading this on the H4. This is too long of a move, too many days for this to be range trading. So you're mean reversion trading. When you're mean reversion trading, there's only one thing that is going to invalidate your trade idea, and that is the break of this level here with momentum. And by with momentum, I mean a candle that closes above this, right? And then follow through the next session, yeah, or the next candle, or the next day. Doesn't matter what time frame you're on. Your idea gets invalidated if there's a momentum move. Now, here, look at this, right? You would say, okay, if you were basing it on this one, did this one break this with momentum? Well, absolutely not. The candle did not close above this level, and then it receded, and then it didn't have any follow through, right? So there was no momentum on the part of the bulls to break that level. So that level held, right? Does that make sense to everybody so far? In a mean reversion trade, you're going to look at your the mean reversion point that you're looking at holding, right? The one that has the strongest possibility of holding. Always, because we're scaling in, we're going to enter early, right? So we're going to enter early before that key mean reversion position. And then any break of that mean reversion position clearly invalidates the trade idea, because the trade idea is that price can move up to that key resistance, and it's going to be so far away from averages, and it's going to be so pressured by orders that sit there, that I'm going to get the reaction that I'm expecting. When you see that not happen, because price continues to move beyond that, then obviously that idea is no longer valid. No longer valid. And at that point, you can start doing your damage control. Yeah. Again, we're looking at setting damage control triggers depending exclusively on the validity of the trade idea that you've generated. And in this case, this is a mean reversion trade south. This is the part, the level that you don't want to see broken. And if it does, it's damage control time. Up until then, it's scale in time. Yep. Makes sense? So related to hedges, as soon as that is broken, your hedges or your hedge ideas become valid. And where you select those hedges depends on you. How comfortable are you within your drawdown thresholds, which you should be a lot comfortable, right? Very comfortable. Are there any really cool, good areas from a technical standpoint that could hold as hedges right off the bat? And 3, is the sentiment rallying so hard against me that this is a new trend forming? And you're going to take all those things into account, and you're going to determine where your hedges are going to be, because there's a variety of ways to get your hedges going. So let's say that price breaks with momentum. Yep. So you get this is red, but you get a candle that closes up there way above that, and then the next candle does something like that. Yeah. Imagine, just for the sake of this example. In this case, you've got a couple of options, right? You're going to say, okay, well, what is my first potential hedge zone? Well, the first one is the broken resistance, right? That area there, that was my last bullet, now becomes a broken resistance that has a higher probability of producing a result when it's revisited by price, because again, as self-fulfilling prophecies that technical analysis is plagued with, if this drops down here, this is a value trade for people who are trading the breakout the correct way, right? This is, trading it here on the breakout is not, while there are people doing that, is something that I never recommend. But, moving back down, at that point, you're trend trading, right? To a certain degree, because you are waiting for a pullback on an upwards moving trend to buy, or you're looking for a pullback on a downwards moving trend to sell. That is a trend trade by definition. And that's going to be a solid spot to put your hedge because remember, you have to weigh how much of a hurry you're in for hedging. If you're in a big hurry and you have, so there you've got the first answer to, do you need to hedge? Well, yes. Then the second question is, do I have a good technical level that I could hedge? Well, in this case, probably this one is pretty decent as a breakout. And then you've got some levels probably lower that you can take. And then the third question is, do I think that a trend is developing against my positions? And if the answer is yes, then between needing the hedge and thinking that there's a trend, why don't you trend hedge, trend trade? Yeah. So then the price will drop down here and you'll have a trend trade position long. Yeah. For some people, this might be early, right? If the answer to the first question is, do I need to hedge? And the answer is no, not really, right? I would rather still wait to see if this fades and drops. Yeah. And then I'll decide if I hedge, right? Is there a good level? Well, maybe I don't like this because this once broken resistance, it's in no way support. Where do I see support here? Okay, let me go back into the daily chart, see if this has acted as support before. Probably has. Is it valid? Is it good? Maybe. You'll make decisions like that as you decide your hedge levels, right? What's the closest support level that makes sense? Well, probably down here, right? This is the first indicator on the 4-hour chart where price has stopped from a downward move, right? Or stalled, yeah? So, but that's very close to my first entry, you're going to think. So maybe, another reason not to hedge. And then, in those circumstances, you decide not to hedge right away and you decide to hedge later, see what happens the next couple of candles, right? Again, hedging is very flexible. It depends on your needs. It depends on a lot of things, which is why it is not black and white. And it's why I can't give you a formula that works mathematically well for every environment and context that you find your trades in, Unfortunately, it's not how it works, which is why you have to train this and you have to think logically, and every single trade is going to be under different circumstances. Yeah. But the fact of the matter remains is that you are going to be asking yourself these questions, and your hedge zone, is going to come out of the answers that you give yourself. Yeah. But in this case, excuse me, the placement of the damage control trigger was based on the invalidation of the trade idea, which was price is going to hit a key level and retrace, which it didn't. Yeah. And then the placement of your hedge zone, in this case, is based on the fact that you might need a hedge. You want to trend trade it because something radical has happened in sentiment, and all of a sudden, oh, I'm a Euro bull. I can't have this trade here going against me. I've got to start, buying this. And then you buy that and you generate your gains through trend trading to slowly, over time, wash this in as many cycles as is needed, always keeping an eye on your drawdown.